Peter
Depending
Thiel's
on
founder
how
fund.
how big this black swan is for a lot of tech companies, do you think there's going to be like some sort of fintech like renaissance or something? Like,
I cannot believe you cut me off to fucking say that. What the hell are you talking about?
Tannor, you go
I'm
to
on
the States
vacation.
once and you become so much more aggressive on these pods.
I know.
Yeah, bro, you're
I
a
know.
Canadian. You're supposed to be nice. You get
No,
to
he's a
Florida,
Florida
you turn
man
into
now.
Ron
Tannor,
DeSantis.
you're a Canadian? I didn't know you were a Canadian.
Yeah, my friend, in Toronto.
You-
No.
you
Go
have-
These
ahead,
guys,
Riley.
bro,
Yeah.
Chris, these guys are such fucking frauds. They don't even have SoFi accounts. Talking about they're on a SoFi.
Whoa, y'all don't have SoFi accounts?
Nope, they're in Canada.
Wait, Chris,
Oh,
you don't have a
God.
Palantir account?
What are you talking about? I have Palantir certification, bro.
Chris actually literally just got his Palantir certificate. He literally just got it.
Oh, okay, got you. Yeah, no, I'm a Google employee too because I got the free online course. Okay, listen.
Let's get into this. Silicon Valley Bank has failed. If you were the bank of startups, just like if you were the bank of crypto, it turned out that you had made a huge concentrated bet on interest rates. This was 2021. Your customers were flush with cash because startups kept getting funded. This is the Silicon Valley Bank, so their main clients are startups. So they gave you all that cash, but they didn't need loans, so you invested all that cash in longer dated fixed income securities, which obviously are giving better rates than investing in equities, which lost value when rates went up. But also when rates went up, your customers all got smoked because those startups didn't really deserve all that funding. This was the boom and bust of 2021 because it turned out they were creatures of low interest rates themselves. And in a higher interest rate environment, they didn't have money anymore. So they have to withdraw their deposits from the bank. So you have to sell those securities you invested in, about $2.5 billion of a loss, to pay them back. Now you have lost money and look financially shaky, so customers get spooked and withdraw more money because they don't want to keep their money in a bank that's going to go under. So you sell more securities, so you book more losses, oops, and ultimately collapse after Jim Cramer says that you are a good buy.
Gary Tan said that it could be an extinction level event for startups. I think that it's just going to shift who the big players are, but this is massive. This is going to be a lot of pain for a very niche but important sector of the economy for innovation. Silicon Valley Bank is the 16th largest bank whenever it comes to assets under management, but they also deal with a very specific niche, which is, VCs.
This is the biggest banking crisis since 2008, the second biggest in US history. Since this is the bank that deals with a lot of tech companies, a lot of startups, what FTX was for crypto, it seems to be that this is for major financial institutions and tech companies. It's very important and it's very relevant to not only SoFi, but the entire fintech space. And moreover than that, the entire market in general, because of how many different lines of connection there are between Silicon Valley Bank to everything else in the market.
You're completely right. I mean, lower the scam level and increase the reliance level for the overall market. SVB was a critical point. What we're realizing is that once one of these players actually goes down, you're realizing how little players are actually this niched up in this area. The contagion is looked at in two ways. What is the biggest buyer of financial institution companies? And funny enough, it's financial institutions. I guarantee you, JP Morgan had exposure, Bank of America had exposure, Credit Suisse had exposure. They all will have exposure because that's part of their diversification, is buying a whole bunch of banks in an industry that they love. The alternative to the contagion is maybe a good one. There might have been some issue before this company went down, but now you have a massive new stream of deposits that are actually coming to First Republic Bank, Signature Bank, Pacific Western Bank. These companies were also lacking deposits, but because one of their peers actually fell, that's $42 billion that just rushed out of that company and going to the competitors. They are probably also seeing right now a huge rush of deposits because one of them actually fell, one of the top pillars. Do you think that there's going to be a bailout, Chris?
Bailout who?
Bail out the depositors.
Well, first of all, there are assets in the bank, right? So there's no real need to technically bail them out.
They had negative $985 million yesterday.
The treasuries?
Yeah, the
no,
reserves that they had for the deposits.
In terms of liquidity, is that what they're talking about? Or is it just like overall? Yeah, so the thing is, remember, all of their money that they have is in treasuries. This is where they really messed up. They took money in the short term and lent it out in the long term, which is fine. Everyone does that. That's how a bank works. Problem is, when the Fed raises rates too fast in the short term, a lot of those people that you lent the money to, you're not expecting them to give that money right back. It takes time. These guys, they took all the money they got in the short term and just bought a whole bunch of treasuries because for some reason they thought interest rates would never go higher, which is dumb. And as they were starting to go higher, they should have been liquidating their treasuries and making the maturities closer and closer closer to their original price, but they didn't do that. So now all of a sudden they have a liquidity event. They do have assets. I don't think they need a bailout. Think about what's going on with a Silicon Valley Bank and then look at First Republic. First Republic has only $4 billion in cash.
Okay, this is the actual stock right now. This one collapsed.
You tweeted about FRC yesterday. You said it's going to be way, way, way worse. It's not going to be way, way, way worse than a stock that is no longer a tradable company anymore. Like they went full, they were $16 billion yesterday. They're zero today. I don't think it'll be that much worse. In fact, I actually think that this gives some more time to FRC because they are going to see a lot of deposits from Silicon Valley Bank actually going down. A lot of those people actually trying to get out of there and put their money somewhere else. It's the same thing whenever FTX went down. It actually at first looked to be terrible for Coinbase. And then you realize that, okay, well, those customers still want their crypto exchanges and that they actually just got a huge fund of new customers for that little bit.
This also was interesting because it's not like Silicon Valley Bank is like Lehman in 2008 or Goldman. It's not that. It was the 12th or 15th largest bank. So it's a big deal. But it's not like Bank of America failing.
No, JP Morgan was actually up today because they're actually one of the biggest beneficiaries. All of this money leaving Silicon Valley Bank is going somewhere. Like people are not just taking it, putting it under their mattresses. So right now people are saying, well, who is the best capitalized bank? Who do I know that I can get my money from? Who has banking relationships? And JP Morgan has been working overtime to open accounts and get money in the door as fast as possible. So JP Morgan is actually benefiting like crazy right now. Their total assets are going to go up like crazy because JP Morgan is the most well-capitalized of the big banks.
Is that just due to risk aversion though? Like naturally my mind would go towards a bigger bank as opposed to like a regional bank for risk aversion purposes.
Absolutely. Absolutely. Like think about it this way. Of all the major banks out there right now, who do you least expect to go bankrupt based on just total assets that are out there? And it's JP Morgan, right? You wouldn't want to put it into other speculative names, even though some of the speculative names, SoFi, give like 4% interest on your money.
Is SoFi F? What do you think?
I mean, they do have some relation, but it's very, very small.
They tweeted. They said, we don't have any issues. They said, stop hitting our lines. We're good. And then Noto bought 180,000 shares to kind of tell shareholders, hey, I believe in the stock. We're fine. Chris, any thoughts on Noto buying shares and basically saying we're good?
Right now, every single CEO on Wall Street is trying to come up ways to give confidence to its shareholders and also to its stakeholders, because the last thing you want right now is a run. SoFi right now, if let's say a third of their members said, you know what, I don't trust my money with SoFi, and they did a bank run right now, SoFi would be out of business like tomorrow morning. Why? Because most of the money that's out there is not liquid cash. It's sitting in personal loans that are out there that SoFi has lent out. They're healthy banks that actually make money. The problem is when you have a bank run, you need liquid capital sitting on your balance sheet. So right now it's all about shoring up as much confidence as possible that, hey, we don't need the money. Hey, we can support withdrawals. The good thing about SoFi is that they don't have concentration risk like Silicon Valley Bank did. Silicon Valley Bank, I think, had a few thousand accounts. I think maybe like 30, 40,000 accounts that were mainly companies. So there's a lot of concentration there versus SoFi, who's got millions upon depositors.
Whenever we're actually looking at SoFi, the difference is that one, we don't have a lot of that old term treasuries or anything like this. We're a brand new bank. So we're just starting our portfolio right now. Secondly, no one's running from 3.75% deposits. This is the place people are running to. But whenever we actually look at deposit growth, SVB was one of the lowest ones along with New York Bank Mellon or whatever it's called. The opposite is happening for SoFi, where we're seeing like 500% growth just because our portfolio is that new.
The reason why SoFi is growing its deposits because the attractive interest rate that SoFi is offering. They're not doing charity work. They're giving you a really good rate of return for your money. Now, how are they making that money? Because they have to make money to give you that good rate of return. The way they're doing it is personal loans that are out there that they're charging 11 and 12% interest on. My biggest concern with SoFi has always been around delinquencies. Now, everyone is saying, well, you know what? Delinquency rates are going to be fine because number one, SoFi still lends to only really high FICO score individuals, which is totally cool. Like I get the business model. Originally, they had started this to help finance people like doctors and nurses who may have been in a difficult financial position, but they're still generating a ton of income that they had to refinance their loans and all this other stuff. So that's where they started. And I still do believe if the numbers on their FICO stuff is correct, that SoFi doesn't have anything to worry about. My problem is if delinquencies go up because let's say the economy goes really bad and really sour, how much of those personal loans are they going to have to eat? The losses on those loans are going to have to eat. That's the biggest vulnerability. And then on top of it, it gets to the point where if SoFi has any trouble paying their creditors or has to lower their interest rate just to keep their deposits in line, that means that if there's a run on SoFi, then same thing's going to happen. SoFi is going to get hit with a tremendous amount of pressure to sell those assets because they have assets, right? Think about the personal loans that they have. Those are technically assets. They're going to have to sell them. Now, the thing is, when you're in a bad place, no one is going to offer you par value for them. They're all going to say, hey, I'll buy them off your hands for 25 cents, 50 cents on the dollar, which is exactly what's happening with the treasury.
So the way SoFi collapses on this, or any type of neobank, is not because of Silicon Valley Bank collapsing writ large and that having a ripple effect. Rather, is if the ripple effect of SIVB collapsing creates an economic meltdown, not Lehman in 2008, but if it does something similar to that, then delinquencies will happen for those personal loans that SoFi has assets for, and that would cause a bank run on SoFi because they can't afford to pay the interest rates. But barring some major economic catastrophe because of this event, which I think we can all agree, I don't know if this is a catalyst for like a Lehman in 2008 type of Great Recession crisis, SoFi should be fine.
I personally do believe in what SoFi is putting out. And then also look at the rating agencies that are also rating the loans on their balance sheets. It was completely different between SVB and SoFi. The idea that it would be AAA rated would mean that we would have the lowest amount of actual discount versus anything else. Like BBB loans would have the highest amount of discount. AAA would have much, much less.
Saying is there's two things about their FICO scores that would concern me. Number one, when these loans are issued, that's when your FICO score readings are, because that's what they say. At the time of origination, this is the FICO score of the individual. Let's say I make $150,000. I fit right into SoFi's profile. I'm good. I pay all my money on time. And then I have a credit event. Let's say I lose my job. Do you think my FICO scores matters at that point, whether I can pay that loan back or not? You know what? We are going to see in the next year, 2 years, how strong the borrowers of SoFi really are. Anyone who took out a personal loan, we'll see. Like I said, I'm not saying that it's definitely going to happen, but if delinquency rates start to go up because people lose their jobs, that's what happens during a recession.
The idea that some people are getting loans and then at the time that they actually got that loan, they had a high rating and then it recently dropped is the same thing that would have happened in 2008. Right? It's just an arbitrary number. We understand that it can fluctuate, but that's still considered very good risk to have taken on. There's not a particularly or sign that the people that go with SoFi end up quitting their jobs regularly than any other person that might have a 760 plus FICO score. So you kind of have to look at it the same way that JP Morgan has clients that have over 760 is the same way that SoFi has a client that's 760. The delinquencies could stay the same.
We're looking at 2008 and saying, well, you know what? 2008 was fine, so this time is going to be fine also. I don't necessarily think that. Like 2008, Silicon Valley Bank survived. This time they didn't. There's a lot of differences between 2008 and now. Like in the past, in 2008, you had a subprime lending event where people were just putting down, oh, I make $8,000, $80,000 a year, give me a loan, and people were just getting it. There was no background checks and everything else. This time around, that's not there. But that's not to say that there aren't other factors.
What about things like capital ratios and these sorts of things that were totally not monitored back in 2008? Like where banks can hold at least 2% high quality capital in order to facilitate their loans. Now you look at SoFi and they have over 14% on their books to actually make sure that their personal loans are actually being facilitated. And by the way, the Fed, the OCC, the SEC all have looked at our charts and said, even though you're running personal loans, we'll still keep the minimum at 7%. That's lower than lending clubs. I don't know how SoFi could show you any more than that to say, hey, we are playing it safe. We're actually not doing dirty work. Like, of course, we're still growing. We just got a bank. So the amount of loans are going to skyrocket and the delinquencies are going to skyrocket, but we are growing at such a high rate as well.
When dollars shift around in these types of events, there's two reasons that I can think of. One is for opportunity, in which case SoFi's yield would be something that's attractive to people shifting their dollars around. And the other one is fear. Can this bank remain solvent? I understand delinquency rates can rise, despite in the Q4 earnings, they basically said it's at 2019 levels, like pre-pandemic levels. It can rise, absolutely. But as delinquency rates rise, they rise across the board and affect every single financial institution. And if I had to make a list of all the financial institutions and put SoFi on that list, with SoFi's metrics where they are, I would put them towards the more safe aspect, especially considering their cohort is generally more affluent people. Again, operating from a place of logic that would have more of a buffer financially when times are tough to sustain themselves until they can bounce back with another job. If we think of SVB, SVB, I'm viewing it almost similar to FTX to say, what were all of the institutions that were connected to this? Those are the next at risk. But right now, what we're talking about is we're talking about a full economic meltdown that raises the tide of delinquencies across the board for all financial institutions. And just fundamentally, I think that it's opportunity versus risk. You know, an attractive return for me to put my money in a safe place, and it's, can this place stay solvent?
Nearly half of all U.S. venture capital-backed startups were involved with the Silicon Valley Bank, per Bloomberg.
Not mine.
And
Good old Bank of
88%
America.
of Forbes 2022 next billion startups are SVB clients, which is insane. And
Roku had about $478 million of exposure to SVB, and Chris, you'll get a kink out of this. Ginkgo had $74 million in SVB.
that's crazy. And then Circle at the bottom of this little table here, 25% of their cash reserves were in SVB, and they're the ones controlling USDC. This feels like a black swan for tech, like out of nowhere.
When we talk about the actual companies that were linked with SVB, I think one of the interesting points was the FDIC insurance, right? One reporting said as much as 90% of all deposits in SVB were higher than what the FDIC cap was of 250,000. A very, very large percentage won't be insured.
They're definitely going to get their money back. The problem is liquidity. Like the FDIC is going to take all the assets, try to sell them slowly, and give the money back to the creditors. Because now all these people end up on something called a creditor committee, and they're all going to get their money. But the question is, you don't have that money to do other things with. Like, let's say right now you were about to invest in a building, you were investing in new software. You're not going to do that. You were planning on hiring people. You can't do that. As a founder, you're pretty much stuck. The hero of the story is going to be the FDIC and how quickly they move to unfreeze that money and get it back to these other companies so that they can keep their payrolls running. Like, and that's why I put out a tweet earlier today. I said, I wonder what the exposure to these big tech companies is going to be, because remember, they all provide services to the smaller tech companies that are still in the founding stages, right?
That was a good point that you brought up, Chris. And the idea that Amazon, Google, Snowflake, they all provide a ton of services to smaller startups, or even, Series C, Series D startups. And if those companies can't make payroll, much less pay for those bills, that might have an impact on earnings, which might be kind of a bit of a catalyst going into Q1 earnings for 2023 for a bad earnings report, at least, not a good one.
Yeah, I mean, it is crazy, right? Even though their market cap was quite low, the assets under management here was like 200 something billion. It was the second biggest bank to fail since 2008. I think it was Washington Mutual is what I think I read was the largest bank failure in the United States in terms of assets under management. Chris said they'll all get their money. I mean, hopefully, all the goodwill and all of this stuff in terms of the actual name brand of the company are completely gone, right? Even though they kicked Sam Bankman-Fried out of FTX and then they go, okay, well, the withdrawals are back. No one's using that company again.
As I understand it, there's only a certain amount that's FDIC insured, but you're saying they're going to get all their money back?
They're a chop shop, right? They're going to take this whole company, see what they own, and sell it off to the highest bidder via auction. And then they're going to pay out like a dividend the proceeds back to all the...
But it definitely won't be enough to cover everything, right?
That's left to be seen, right? If you take all their assets, right, which is essentially just treasuries, and you put it into the market right now and says, okay, whoever wants to buy it, dude, every buyer is going to say, I want a 50% discount because you have such a huge volume. That's the problem. Now, here's the thing. If they sell it, let's say 5% here, a few percentage here, a few percentage here, they'll actually get a fair value on the asset itself. If you are trying to sell a whole bunch of assets in a very tight market where right now a lot of people aren't exactly happy with the cash that they're going to ask for huge discounts. And those huge discounts are going to basically mean that all the creditors may not get their full value. That's the other issue also. The ideal scenario here would have been someone like JP Morgan buying the company out, using its depositor cash that they have on the side to make sure that there's enough liquidity so that all these guys are made whole.
Why didn't JP Morgan buy them out this morning? Why?
Because JP Morgan probably asked for 5 cents. They probably asked for 5 cents on the dollar, dude. That's what I would have done if I was Jamie Dimon. I would have said, no, I'll give you 2 pennies to rub your hand with.
Why would JP Morgan buy them out when they're the main beneficiary of all this money that's flowing out?
That's the other thing. Good point, Tevis. Why would you end up doing that? Because all these guys are coming to you as clients anyway.
How in the hell is Roku going to give $487 million?
They might get 20% of that.
I think JP Morgan already came out with a statement saying, we're not touching anything, we're not buying, but that's a lie. You know what that means? That just means they didn't get a good enough price.
Tom made a really good point that I didn't think about until he posted it, which was there could be antitrust. JP Morgan's already the freaking large goddamn bank
That's
on the
true.
market. You know, you're not trying to make banks even bigger.
Yeah, I just think they already tried a sale of $21 billion. That alone, they already took massive losses on it. And they did that before people even knew that there was a panic. They had a small little fire sale whenever, people didn't even really know that there was a run. Now,
Right.
supposedly, things are coming out. Founders Fund and Bill Ackman and a lot of these guys, I guess, already quite knew, maybe 6 months in advance, that they were talking to Goldman Sachs and JP Morgan. And there was a little bit of talk that they were in some hot water.
Oh, so you think
so-
SVB knew 6 months ago they were
Okay,
about to go under?
hold on. Can we please, let me adjust my mic for this. Can we please talk about the fucking elephant in the room, which is that the executives sold
yes, we gotta
stock
talk about this. We gotta talk
days
about-
before all of this happened?
And then
And
they
we
said
about
to
it.
keep calm to their investors days after they sold everything.
Yeah, this
they're-
is
they're straight going to prison.
incredible. I mean, this is so the CEO since December 28th, Gregory Becker sold $3.578 million of share. Look at these share prices he's selling at 287, 300. So on February 27th, he sold 12,451 shares at $287. Today, the stock is zero. And this was today's March 10th. This was 2 weeks before this all went to shit. You can't tell me you didn't know 2 weeks ago that you guys were in deep shit. So do you think he gets busted on insider selling?
1,000%. He used
He has enough
non-public
money
information.
to buy a lawyer.
He used non-public information to make a private sale.
What if he
So
just says, "Oh, I felt like selling. Like I woke up and I kind of just felt like."
then he would need a long track record of doing very similar activity.
Nothing's going to happen. They'll just slap on the wrist. All these guys have enough money and lawyers to just take a slap on the wrist, move on.
They'll get a
Whoever
fine
this-
that's a fraction of the sale proceeds, and there we go.
Like,
Maybe
there's
there could be a
reason why-
clawback of that, and maybe the government's like, "Hey, we got," because that's $4 million. I mean, it's not a lot of money, but Roku could use that 4 million more than Gregory Becker probably.
Yeah,
right?
the person that bought those shares, the John Smith on the other end of that deal, is down $4 million. They're not down 60% of it. They're not down 50%. They're down to zero.
No one cares about the retail trader, okay? It's nothing that anyone's going to do anything about. Just retail traders are going to get waffled on this. So
SVB also had a venture capital investment arm of their own where they had like 800 plus investments into other VC companies, which were also not doing good in private markets. Whenever they were going for this fire sale, they had nothing good to sell. And probably, and I haven't looked this far back, I bet 6 to 9 months ago, they probably did have a couple good assets and they had sold those off already, hoping to extend their runway.
a counterparty risk too, right? That's the other thing, because there's a lot of innocent companies that had nothing to do with this that are going to be negatively impacted. Remember, what happens is when an atomic bomb drops, it's not just the center point where the bomb hits, it's all the surrounding stuff around it that's also going to get hit also. So right now, if you look at California and the region that they're in, if all these tech workers start losing their jobs, these founders start losing their hobbies, their money, that means that, guess what? Their local real estate market is going to start collapsing. The local commercial real estate market, that's actually another problematic area. Commercial mortgages right now are kind of teetering because occupancy rates are not that great right now. So this is just one more thing that could lead to more dire economic consequences. This is how the market cycle works. There are times where things are really good, and then we get a little too punch drunk, thinking that everything is going to be normal like this forever. And then guess what? Once the punch bowl is taken away, everyone is like, it wakes up from their high and just like, oh my God, how did this happen? And I'm looking for companies that have well-structured balance sheets that can survive this and end up coming out really strong on the other side of it.
This is a video right here of people actually outside of the bank trying to get their money.
This is the hard lesson that we all need to learn and take.
This was almost like a leveraged bet, right? If VC continued to climb, this would have been looked at as one of the best performing stocks ever. I mean, JP Morgan, even while this was happening a month or two before, they gave this stock an overweight rating of $375. This morning, it was worth 10% of that. Today, it's worth 0% of that.
You made a bet with a bank. The bank failed. You lost a bet. Why is it the government and the taxpayer's responsibility to bail these people out?
Yeah.
Why is it always the taxpayer that ends up having to deal with this?
Go ahead, Ken.
The reason why they're the bailout people is because they are unsuspectedly and unknowingly going to be dragged into being a victim of this actual bank collapse. Like that's the problem, is that there's so many ties to these banks that you probably don't even know that if you are an LP, for example, that the venture capital company that you had trusted is making sure that the businesses that they're investing with had that money in this bank. All their money is tied up. They can't pay employees. Payroll comes around and the businesses like multiples get chopped by 75%. And then that gets sent back over to the LPs. And then obviously they lose a ton of money. And they had no idea that this was happening.
Silicon Valley is unique to America. It's a state of mind. And it's a state of mind that in America, you can try to do something that likely is going to fail. And you will have the capital in order to go build that thing. Like Facebook, Amazon, like Facebook doesn't happen unless Peter Thiel gives Mark Zuckerberg $500K when he's a 19-year-old kid who's socially awkward. But like the culture of America is that LPs, limited partners, the Harvards, the Stanfords, these endowments of the world, they will take billions of dollars, give them to people like Andreessen Horowitz, Sequoia, General Catalyst, Mayfield Fund. And then those general partners will tell those LPs, hey, we're going to take your $2 billion and you give us 10 years and we'll turn it into $6 billion, which is way better than what you would have got investing in public equities, because we will invest 95% of it into what we think is going to be the next Google. All of them will fail, and we will somehow find you the next Uber, and we will make you back 10,000 times your money. That is unique to America. And the bank that was supporting that unique, innovative, like amazing culture just collapsed. And so that's why this really does suck, because again, that goes back to the LPs, and they're like, well, wait a second, why should we give you our money now if you can't promise us a return?
First of all, let me just say that I'm not for bailouts. I think that these institutions being allowed to fail is a feature built into the system and not a bug. But the case for bailouts is that banks, from a leverage ratio perspective and a liquidity perspective, can crank up the multiples by which they can command liquidity much more than individuals can, as a result of just regulators in general. And so it's just like, well, why are you allowing for banks to take these risky positions if you're a regulator? And then when they fail, you're the one that has to bail them out. Like, from a regulatory perspective, if you can allow a bank to go 50x, 100x, then that's just a recipe for disaster waiting to happen. And that would be a case that I could see for a bailout. Is this the regulators basically made the rules, don't hate the bank for taking advantage of them? I don't know. Maybe that's a simplistic way of viewing it.
Let's also understand that, like, most times a bailout is not, a free check that ends up going to these businesses. I mean, the government makes their money, right? They put it in offers with crazy amounts of equity, loans most of the times. They always structure it in ways, I don't know what the returns would be on a lot of these things, but they're extremely, extremely aggressive. I think JP Morgan, Bank of America are going to be the biggest, beneficiaries of this, just because people need to run to some safety net, and they're not going to store it under their couch cushions, like Chris said. And so I do think the big banks will benefit in the short term, but I do think that there will be a return to a lot of the normal banking procedures that people go back to all the time.
I was going to say, Noto bought 180,000 shares. Tannor, what are your thoughts on that?
I like when he buys. Like Chris says, there's no higher amount of shareholder alignment that he would like to see, but I do think it's just a calming thing. He's a rich man. He can throw $1 million to calm some nerves.
Like, Noto just always seems to buy at the best times. And last time he bought in December, it was literally the bottom. I think he caught it within like 10 or 15 cents of the actual bottom of the stock before the market turned around in January, when everybody else was like tax loss harvesting back in December. Noto's buying. Obviously, it's coming at a great time, especially considering SVB, but also considering the whole Department of Education lawsuit and a lot of the negative backlash that they got around that. And
I think this is something he had to do today, because
Yeah.
SoFi is a neobank. A lot of people are not going to be as deep into it as us. We're going to, they're going to think, oh, it's going under, blah, blah, blah. And a narrative can form when the CEO says, nope, I'm going to put $1 million of my cash into the company today. Out of all days, it was the best day to do it. So
yeah, I do think you're right. A lot of people think banks are banks, don't understand the difference in the exposure. And he obviously likes buying the stock with his own money anyway. So I think it was just great timing.
Here's the question. What do you guys think is going to happen next week? Do you think there's more contagion? Are we going to see other banks start to go down?
I think it's going to get ugly. I mean, these startups are not getting their money back. Things are going to get ugly. I don't know what that means, but
I have a few questions. Like, how many startups are actually going to be like completely destroyed by this? how many people are going to be looking for new work? And will this change like anything in tech? Do we do banking in a different way? It's probably going to be some regulatory like action or pandering, or I don't know. Like 2008 had a lot of changes to the system that we have now. What do y'all think?
Yeah, unlikely any regulatory change in my opinion. And even if we do see something, it's going to be this long drawn out process of having hearings as to how this happened. And everybody has their own virtue signaling little agenda during those hearings. And inevitably, nothing really gets done.
My question is, how many public companies have exposure? Because that's where the question is going to be. Look at Roku. Roku's put out a press statement, said, look, we had this much money. How many other 8Ks are going to be filed in the next week saying, hey, sorry, guys, we had a lot of money with SVB. We didn't mean to, but, we fucked up.
They have 200 and something billion dollars in assets under management. Somebody owns them. I guarantee you it's not a bunch of ideas that are holding $200 billion. There's going to be some huge companies. I have a feeling Shopify is definitely going to be on that list. I have a feeling that Coinbase is definitely going to be on that list. Circle is on that list, and Coinbase these guys are tight. So Coinbase is probably definitely going to be on that list. But that's what happens when an entire industry is centralized to a couple players.
What I hope
we're obviously really well connected. Go ahead.
I mean, what I hope is that this does not lead to the decline of startup culture or startups in general, which I don't think it will, because America's pretty resilient, and LPs, they don't want crappy returns from the S&P. They want to find the next Uber. So, I mean, I think that that risk-taking culture is not going away from capital allocators, but it doesn't seem like a Silicon Valley bank will ever form again and be as centralized, as you said, as it was. As you said in the beginning of this pod, things are so cyclical. And like in 2021, everyone feels on top of the world. Like saying Tesla was going to be at 200 at this level, right, in 2021, you would have sounded like an idiot. You would sound like someone who doesn't understand what's going on.
I think every company is going to have to drop a statement saying they have no exposure. And I think that's going to be the telling thing. Because at this point, if you're saying you don't have exposure, you're good. But if you don't say anything, that's worse, because that means that you could have exposure, right? So every company right now out there is probably having to like make some statements saying, hey, we either do or we either don't. I'll say this, we'll know more next week. 2008, 2006, a lot of this stuff was happening, but until everything started to come ahead, no one really knew. Like, this is the first salvo of something that's coming. And if this doesn't come out and be really bad for the next 2 weeks, then maybe we have a little bit of breathing room ahead of us. But next week, I expect to see some major waves in the market. Let's just say that.
And just to tag on to that, like the end of that super chat, having a big chunk of cash on the side is never really a bad thing, especially in times like these.
That's why Palantir has 2.6 billion in cash. Just saying. Oh, Coinbase paused USDC.
Isn't USDC getting depegged? I think Michael commented that it's like it's 97 cents, which is giving me like Luna PTSD.
Breaking news: Coinbase pausing all USDC. Wow. I mean,
I think so. Is this as a result of Silvergate?
USDC is by Circle, and Circle has 25% of its cash in Silicon Valley Bank.
I've never been pegged before, but this idea of them USDC being pegged, it's very interesting to me.
Whoa, did you say you've never been pegged before? What the fuck?
It wouldn't be a SoFi Weekly without one of these comments from Amit. Golden showers. I mean, come on, man.
Every time people are like
so good, an hour and a half, we did so well.
Every time people say stable coins are pegged 1-to-1, or I just think immediately about
bro, what have you watched? What kind of what's your browser history looks like? That's what I want to know.
I just had to say it to see Tanner's face. I go back to these pods later in the night, and I go back to reverse to when I say something crazy, and I see everyone's face. And it's incredible.
It definitely livens up the pod for sure.
That is true. Okay, so I guess Coinbase is doing some crazy stuff. Another story that's developing, and we'll see. You're temporarily pausing USD conversions over the weekend while banks are closed. During periods of heightened activity, conversions rely on USD transfers. We plan to recommence. So Monday, they're opening it back up. That's what they said. And we'll see you guys next week.
Thanks, everybody.
Thank you, everybody.
Bye, guys.